tend to think of money, of currency, in national terms. That is, we use the currency of our country when that currency is protected by legal tender. It is also true that you can write contracts in other currencies. If in Britain you write a contract in dollars, then the courts will force you to pay in those dollars you've contracted. So, in fact, people use many currencies, and one should open the concept of money to the international world. Rates of exchange tell you how much one's currency is worth in terms of another currency. And that changes every day, depending on the circumstances and on the confidence in the local central bank. So, if we look at currencies in that sense, we are confronted with what is not a legal monopoly, but a world oligopoly. The different currencies compete, and different central banks compete with their currency. Because the more people use the currency of a central bank, the greater the profits of that central bank. Depending on the three functions of money, there's been an incentive to use more than one currency. For payments, you tend to use the local currency. If it's for measuring prices, you tend to use the local currency, but it depends on whether you can put your confidence in it. And then finally, the third use of money, which is the store of value, there everybody uses many currencies. If they buy a fund, if they have a pension fund, or if they have an investment fund, usually they will choose a manager or a fund that has their money in different countries, simply to spread your risks. We must see money as an international institution where value is not so much because of law, but because of the way people use it and the way that banks issue that currency. We don't know what will happen with digital currency. So many new currencies are coming in, and they are competing with one another and with the national legal currencies. Central banks are not autonomous. They have to behave, and if they don't behave, they'll be punished by people moving to another currency.